Good afternoon, and thank you for joining us for the third investment webinar in our series. This webinar will look at ESG implications for trustees, and I'm pleased to see that we've got guests joining us from a few different jurisdictions this time. We've got some from Bermuda, Cayman, some from Jersey and Guernsey, the Isle of Man, and also from South Africa. So thank you for making time in your day to join us. In this webinar, we're really going to focus on ESG investing from a trustee's perspective. And the webinar will have three content sections, and then we'll have a debate. So section one, we'll look at what's shaping the ESG landscape at the moment. In section two, we'll try to debunk the underperformance myth of ESG investing. And in section three, we'll focus on tools to help trustees set ESG objectives. And for the debate, I'll be joined by James Fitzpatrick, one of our portfolio managers, to discuss the arguments for and against including BP in an ethical portfolio. James will bravely be making the case for inclusion. We've also set up a poll question, which you'll find on the right-hand side of your screen. And the question is, should BP be included in an ESG portfolio? Or, as our webinar invitation noted, can you put green lipstick on an oily pig? So you're very welcome to vote during the webinar, and we'll let you know the poll result at the end of the session. So moving into section one, what's shaping the ESG landscape in 2020? I think it's unavoidable to look at governance first and to look at COVID-19 and how this is testing the governance framework at the corporate and government level. From a society perspective, we're seeing health and wealth inequalities being cast into the spotlight by the pandemic, as have employment practices. From an environmental perspective, the climate change emergency remains prominent, and although it has been somewhat overshadowed by the pandemic, it's intrinsically linked. We don't have time to unpack all of E, S, and G fully in this webinar. It would take us days. So we're going to focus on a few key areas and also look at the implications for trustees. So ESG strategies have seen a huge increase in investment, predominantly through the rise of ESG ETFs. And we'll question a little bit whether these strategies are effective in tackling ESG issues if they're based solely on exclusion criteria. And we've also seen in recent months ESG managers being caught out with high-profile exposure to the likes of Boohoo, which had issues around working conditions, and also Wirecard with the issues of fraud. And this has highlighted the importance of due diligence and has tested ESG scoring practices, which still remain largely subjective. And we'll come on to that later in the webinar. And I think a question to raise is, will the pandemic lead to a paradigm shift for the global economy towards a more sustainable future, or will we see companies and governments revert back to seeking growth and profits irrespective of the ESG consequences? So if we have a look in one area of government stimulus that we've seen during Q1 and Q2 this year, how does that impact environmental considerations? And for those of you who didn't join our second webinar, we looked at government intervention in markets through the purchase of corporate bonds, both ETFs and directly. And this in itself creates a conundrum for governments, as some of the companies seeking assistance are in carbon-intensive industries. From a UK perspective, the new Bank of England Governor, Andrew Bailey, has pledged to decarbonise the Bank of England's balance sheet. But will the response to COVID-19 jeopardise those commitments to reduce all greenhouse gas emissions by net zero by 2050? The upcoming election in the United States will have a material impact on climate change. Remember, President Trump has communicated intent to withdraw from the Paris Agreement. And according to the FT, Joe Biden is planning to unveil a $2 trillion spending plan to use climate change policy to drag the economy out of its pandemic-era recession. So it may be a binary outcome in the US then. The EU has tended to lead the way on climate policy. Where does this sit on the agenda in the midst and in the aftermath of the pandemic? China, still the world's largest polluter, emitting 13,500 metric dioxide equivalent in 2019, did ratify the Paris Agreement, but sets its own agenda. So let's take a look at how they're faring. And one does fear that as with global debt, global emissions targets are a bit of a can that can be kicked down the road by governments and companies. So we're going to have a look using the Climate Action Tracker at how the US, Europe, UK and China are faring in those goals towards 2050. And the Climate Action Tracker provides an assessment of nationally determined contributions. And those nationally determined contributions embody the efforts by each country to reduce their national emissions and adapt to the impact of climate change as set out in the Paris Agreement. And for those of you that like the details, you can find that in Article 4, Paragraph 2. And it's measured in metric tons of carbon dioxide equivalent emitted each year. And there is a scale that you will see on each of the graphs, which really rates each country and how they're doing now and how they are progressing towards their target. And the categories that we'll see are critically insufficient, which is if they're in the grey zone, highly insufficient if they're in the red zone, insufficient if they're in the orange zone. And we'll see some of the countries in that zone, and that insufficient definition is commitments with this rating are in the least stringent part of their fair share range and are not consistent with holding warming below that 2-degree level, let alone with the Paris Agreement, which has a target of 1.5 degrees. If all governments' targets were in this range, warming would reach over 2 degrees and up to 3 degrees. The next level down, yellow, there's then a 1.5 degree green level, which is the Paris Agreement compatible level. And then there's a role model level. And we'll see that none of the countries are in that role model level. So I'm now just going to share screens for you, and we'll take a closer look, starting with the UK. So if you can see on the screen there, we have the emissions from 1990. So if you follow the black line, you can see the UK was emitting 800 metric tons of carbon dioxide equivalent in 1990, and has gradually progressed down to above 400 metric tons of carbon dioxide equivalent currently, and you can see there is a trend and progression line there. Now, in contrast, if we have a look at the USA, we can actually see from 1990, really there's been very little improvement or reduction in those emission levels. And actually at this rate, the US would sit in that red band. China is still the world's largest polluter, and we can see actually over the course of 30 years from 1990, the level of emissions has increased dramatically, and even with the current policy projections, that level is not looking like it's likely to decline. And then if we have a look at the EU, we can see that the emission levels have decreased and actually are projected to decrease further. But how much of that is an indication of declining industrial production in the EU, and similarly for the UK, as opposed to meeting the targets that have been set under the Paris Agreement? So then if we look at a more positive element, we can see that there is a race on between China and the US in terms of renewable energy. And this graph, which I'm going to share with you now, will just illustrate that briefly, showing spending by the US and China since 2005. And we've seen a gradual increase in spending. So as we've seen with the trade war between China and the US, there are many different fields of battle, if you will. And actually on the positive side, the spending on clean technology is increasing. And we see that as being positive from an ESG perspective. So the environmental factors then, if we compare those four graphs, have not materially improved since 1990, and in some cases have worsened. So let's look briefly now at some of the societal factors. And this webinar isn't intended to focus on COVID-19. However, the development, testing, and distribution of a vaccine is so pivotal to society and to global economic recovery. We've included a chart from McKinsey & Co. that shows clinical trial timelines for COVID-19 vaccine candidates. And we'll share that with you in a moment, but I think the ESG implications are significant, and questions such as, should pharmaceuticals profit from COVID-19 vaccines? If so, when should they profit, and what level will be acceptable? And should wealthy governments be able to pre-order vaccines, as we're seeing them do so at the moment? And I think the large pharmaceutical companies, governments, and also the World Health Organization will have an ESG minefield to navigate once the vaccine is found to be effective. We've had a look there just very briefly at some of the environmental, society, and governance factors in 2020. So I think we'll move on to section 2 of the webinar. We'll start by comparing performance of ESG indices to traditional market indices. Just bear with me, I'm just going to share again some visuals for you. I'm just reloading that. Whilst you're waiting, if you haven't voted in the poll, I'd encourage you to do that. Okay, so we're now back on track. So what we wanted to illustrate here is to try and debunk the underperformance myth that about. And this chart shows through the course of both the dip that we experienced in February and March, and also the recovery that we've seen since, that ESG indices have not only kept up, but they've outperformed traditional indices. So in this graph, you can see the All Country World Index as the blue line. You can then see the ESG Universal Index as the orange line, and you can see the green line as the ESG leaders. As mentioned, you can see that not only was the dip shallower, the recovery has been strong. And this isn't just a short-term phenomenon. If you look over the longer term, the All Country World Index, ESG Universal Index, has had an annualized historic 10-year return of 6.84%, whereas the traditional All Country World Index of 0.38%. And I think that's one of the discussion points that we often have at the outset with clients when they're considering ESG. And I think we have seen the increasing trend and flows into ESG in general. And the chart that we're going to share now was provided as part of an article on Bloomberg, and then really it illustrates the inflows into ESG ETFs over the past year. And you can see that there has been considerable inflows over the course of the last 12 to 18 months. One thing that is apparent, though, is that the ESG scoring by different agencies varies to a great extent. So the slide that we're looking at here looks at some of the world's largest companies. And if we took Facebook as an example, we can see that from an environmental perspective, that the scoring has a great disparity from MSCI scoring very highly to Sustainalytics scoring the very low end of the spectrum. And I think this is something that investment managers, the industry, investors, trustees are grappling with. The element of ESG scoring still remains very subjective, and this just really highlights some of the disparities that we see. I think another area that we have seen is the range and growth of different ESG indices. This slide that we're sharing with you now just highlights a few of those different indices that are now available. So you have a low carbon climate change index, there's the universal ESG index, it's a focused index, there's a leaders index, there's a excluding fossil fuels and faith-based investment index, and there's a global environmental women's leadership impact index. So really there's not only been an increase of flows into ESG ETFs, there's also been an increase in the different range of ESG ETF options. And I think part of the performance myths that have been around for 10 years. I remember being involved in a sustainable agriculture fund from 2010 to 2013, and that was certainly one of the main questions around the reduction in returns that you'd get if you were using a restrictive universe. But hopefully the illustration of performance there demonstrates over the short and long term that actually it isn't detrimental from a performance perspective. And ESG can be used as downside protection within a portfolio, and I think it really depends on what's being excluded and what's being included. When you factor in or out oil and energy stocks, which have been the most volatile asset classes in the past 3 decades, then excluding them on ESG grounds would certainly dampen overall portfolio volatility in the long run. From a governance perspective, there's also a school of thought that companies that treat their employees well are going to be more robust during the pandemic era and therefore more likely to survive. And companies with high ESG scores tend to be innovators and are more likely to invest capital in solutions for a post-pandemic world. And in many cases, they've been investing sustainably in research and development rather than buying back shares to crystallize profits. There is also a subset of ethical or ESG strategies that purport to be uncorrelated to equity markets. And invariably, these are illiquid and speculative and should be treated with the same sort of scrutiny that you treat a traditional asset of this nature. And that leads us on really to the subject of ESG criteria, which we'll touch upon briefly, as I know many participants will already have a base level or higher understanding of exclusion and inclusion criteria. And when you're looking at exclusion criteria, they have been around since the 1980s, and they cover all of those aspects that you'd expect, from tobacco, alcohol, human rights abuses, polluting, animal welfare, gambling, carbon intensive. The list goes on the exclusion side. I think what we are seeing an increase in is inclusion criteria. And those inclusion criteria cover things like social inclusion and education, sustainability changes, healthcare and quality of life, new technologies, food security, future mobility, and a couple that we'll just define that are maybe lesser known, and they'd be something like circular economy. And that focuses on extracting the maximum value from resources and aims to eliminate waste, but with a broader goal of decoupling economic activity from the consumption of finite resources. Another inclusion criteria that we are seeing is base of pyramid. And base of pyramid originates from C.K. Pralahad's theory that serving the poorest in society can generate growth for investors, as well as lifting living standards and economic development. And there are an increasing range of these inclusion criteria focused on different elements of E, S, and G. And from an informed investor's perspective, this provides a vibrant universe of assets to invest in, and leads us on to section 3 of the webinar, where we'll look at some ESG objectives that trustees may want to start thinking about or discussing with settlers and beneficiaries. And a trustee and friend of mine that I've worked with over the years often starts their client discussions by asking what legacy they wish to leave to their beneficiaries and future generations. sustainability in ESG is becoming a key component of that conversation. And I do wonder what wealthy fifth or sixth generation descendants of imperialists think of their ancestors' original source of wealth. The age of empire brought with it some of the most vulgar profits at a tremendous long-term cost to society and the environment. How will future generations view the investment decisions made by today's stewards of family wealth? Will future generations inherit an ESG debt or benefit from the decisions made by settlers, beneficiaries, trustees, and protectors today? And the decisions that investors make now will have an echo through history. In 80 or 100 years' time, will our great-grandchildren look back in abhorrence that we as investors in 2020 were still allocating to non-ESG assets when we had the knowledge that these choices would be to the detriment of the planet and humanity? So how do you go about addressing some of those issues as a trustee talking to a client that maybe has a growing interest and awareness in this area? I think, as we've discussed, ESG investing is still a subjective matter. And as trustees, each of the clients you're working with will have different views. So here's just a few focus areas to cover when assessing ESG objectives for new or existing trust structures. I think, firstly, are ESG investments permitted? Certain types of ESG investments may be prohibited if they are illiquid or if they are speculative in nature. I think to start with, you have to determine the ESG values. Does the client have a natural bias towards one area? Are they more focused on environmental, social, or governance issues? And then are those ESG objectives based on inclusion or inclusion criteria, or a fusion or hybrid of both? And are all the investments to be governed by the ESG objectives, or will there be a separate ESG strategy or mandate that sits alongside traditional investment portfolios? Are the settlers and beneficiaries aligned in those ESG values? Are there multi-generational considerations there? And once determined, I think making sure that the strategies that are selected or the managers that are appointed are matching those ESG values is a critical role of the trustee. And adopting those ESG objectives as part of a wider investment policy statement, I think, is a good way to be able to protect that role of the trustee. And I think every asset within an ESG portfolio should be able to stand up to the ESG objectives set out by the trustees in accordance with the settlers' wishes. Now, in this series of investment webinars, we've tended to focus on broad market considerations and implications for trustees, rather than presenting and promoting Capital International's own discretionary investment solutions. And hopefully this has been appreciated by our audiences. And as we have a slightly more select number of participants in this webinar, and as the subject matter remains still niche, becoming mainstream compared to our earlier subjects, and I hope you're all dialed in because you've got a real interest in ESG strategies, and we'd just like to briefly mention our ESG Fusion strategy. Now, ESG Fusion is a portfolio comprised of ESG funds, and it has a focus on positive impact strategies and resource sustainability. And as a follow-up to this webinar, we will share details of the strategy and would be pleased to discuss in more detail in a private forum. I'll just show a quick slide for you, just to illustrate very briefly the track record of our ESG Fusion strategy. And here you can see ESG Fusion versus the ARC Sterling Balanced benchmark, and you can see a long-term track record there, and also a breakdown of performance going back to inception. And the ESG Fusion asset allocation, which we can go into in more detail in a private forum, is comprised of 35% global equity ESG funds, and some of those are the traditional exclusion type funds. Others are inclusion strategies, and then within the thematic equity allocations, we include three themes within there: clean technology, sustainable agriculture, and water. And within the fixed income component, there are some traditional ethical fixed income bonds, but there are also some global, I think, will become an increasing class within the fixed income element of the portfolio. So we're now going to just complete section 3 and look at an active example, really, and really to show the complexity and subjective nature of ESG investing from a practical perspective. I had a call from an advisor that we've been working with for a trust client only yesterday, and we've been mandated to tailor an ESG strategy for a trust that had a settler that was passionate about ethical investments. And having built and agreed a suitable strategy which was in line with their ESG objectives, we were posed with a question on the underlying companies held in one of the funds in the portfolio. And the question posed was regarding Nestlé, a company familiar to most investors and one which generally scores very highly from an ESG perspective. It's rated AA by MSCI and classified as an ESG leader, and it scores 92 out of 100 in the Dow Jones Sustainability Index. And that stock in particular was included in the top 10 holdings of Pictet Nutrition, which is one of the thematic equity elements of the strategy. And the client had been reviewing all of the underlying positions. And Nestlé, as it turns out, had just been sued by a French fishing federation after several tons of dead fish were reported to have been found in a river near one of their factories as recently as the 9th of August. Now, Nestlé ceased production, however, the damage had been done and reported on. Interestingly, another one of the funds in the strategy that we allocate to is the Triodos Pioneer Impact Fund, and they'd written a note excluding Nestlé prior to the French fishing incident, and they'd excluded Nestlé on the grounds that it had a positive position on genetically modified ingredients. Now, our justification for including the Pictet Nutrition Fund is their strength in agri-tech and logistics, themes that we feel are important components for sustainable growth in the sector. And I think that highlights that part of our role of asset allocator is to monitor and assess how fund managers deal with ESG challenges. And this small example highlights the level of scrutiny with which ESG funds and managers will be judged. There are no perfect companies, and ESG market participants should expect some ESG failures. Assessing how they're dealt with by the companies in question is part of the ongoing active management process. And ESG investors in general will demand a higher level of engagement from discretionary managers and also from trustees. I think we welcome this because we believe investors should know what they're invested in. And whilst it's the discretionary manager's call as to what is invested in the strategy, this should be tested and it should be in line with ESG objectives of the client. There are many ESG stocks that divide opinion. The article that accompanies this webinar highlights Tesla. For some, it's a clean tech innovator. For others, it's a bubble stock with high carbon costs in production. Now, this leads us nicely onto our debate and the final part of the webinar, where we'll take on possibly the most divisive stock we could have chosen, British Petroleum. So on that note, I'd like to introduce James Fitzpatrick, Portfolio Manager. Hi, James.
Hi, Greg. Hi.
Welcome to our webinar, and it's really good to have you joining us today. I think we've brought you in with quite a tricky subject, and just as a bit of background for everybody, James Fitzpatrick is actually the manager that heads up our ESG fusion strategies. So he's in a good position to consider the argument from both sides. So if I just pose the question for you, and I'd be interested to hear your thoughts. From an ESG perspective, how do you feel BP could be included within a portfolio?
Yeah, thank you, Greg. You certainly have chosen, one of the dirtiest pigs out of the pack. But you'll have to appreciate that you have to catch the pig before you can actually, get the lipstick on the pig. But I think it's fair to say that the Globe has certainly captured the pig in BP's case. As you know, they're being headed up by Bernard Looney, and he's made it loud and clear that he supports change and he's engaging in that change. So he's not resisting the change, but he certainly has got a task, ahead of him, a big task. BP are predominantly in oil and gas, as you know. They consider themselves to be an energy company as opposed to an oil company. So it's a bit of a shame that they're called British Petroleum, so they're going to have to do something about the petroleum. So we see that sort of changing in the future. But yeah, as I said, he's put out this target that by 2050 he'll be net carbon neutral. So that's in line with the sort of the Paris goals.
I think that's a really interesting point, and hopefully one that was picked up from the earlier section of the webinar. It appears that governments and companies are setting these goals and targets, but actually they're pretty far off in the future. In 2050, a lot can change between now and then, and I suppose it's looking at the elements of how ESG investors can hold companies like BP and governments accountable. From your experience, having analysed BP over time, how do you see some of those steps that the BP and the industry as a whole is taking towards those climate change goals?
You look, it's a good question. 2050 is a long way away, as you say. It's 30 years down the track. It almost feels like they're kicking the can. A lot can change in 30 years, but they have committed to some much shorter targets. Both in 2025, which is not far off, and by 2030, they've committed to spending 15 billion over that time period. And they've actually put out some quite bold targets that they plan to hit. They've halved their dividend. They're looking to divest out of a lot of their hydrocarbon investments and increase their liquid natural gas product over the next decade. So they're probably going to spend about 3 to 4 billion in the next 5 years. Their sort of 10-year target is 50 gigawatts of power, and they want to increase their electrical point network by 10 times. So they're going to go from 7,500 to about 50,000.
I suppose that in some ways it raises the question of, can they change, and do they have that ability to change? And I think it was interesting following one of their most recent AGMs that they're still pressing ahead with the tar sands development, which from an ESG perspective is sort of almost going backwards rather than going forwards. And how do you think, or how hard do you think that challenge for the likes of BP is going to be, to pivot away from what has been their source of profit for decades?
Yeah, again, it's a difficult question. They can't just switch the lights off on their cash producing assets, and as you say, they have to pivot away. Probably for most ESG investors, they're not going to hang around and wait for BP to pivot, but they are pivoting as hard as they possibly can. So the assets that they've got, they have to work to get the cash and the return on them to make that switch. Where they can disinvest, they've said that they will. So non-core assets will move to create cash and space for the renewables. But that is the challenge. The electrical generation side appears to have a lower return than the network side. So they're hoping to blend the two in order to keep up and maintain the returns that they've had out of hydrocarbons. But they've sort of set out a reduction of 40% in their oil and gas production by 2030, and time will tell whether they're able to actually effectively replace them.
It's a very small poll, but it's interesting to see the responses today that 56% of responders have said they wouldn't want to see BP included in an ESG portfolio. I wonder whether that will change in 5-10 years' time, and I suppose only time will tell as companies like BP try to adopt the changes that they're promising. I think there remains, and probably for trustees, it's a key point. Is can a company ever overcome the legacy of oil spills through the decades, and also were it to be included in the event of a future oil spill? And I think that's something that ESG investors are still acutely aware of, that there could be material damage to the impact in spite of intentions to change course. And I think what it does, the point really of having this debate is to highlight how subjective ESG investing really is. And I think unless you're able to sit down with a client and a trustee and really get to know what's important to them, what they feel comfortable with, how they want to set their ESG objectives, then actually you can end up with a portfolio that doesn't reflect their ESG objectives very easily. Now, from our perspective within ESG Fusion, we'd just clarify that we don't have any exposure to any oil companies, but it makes an interesting point. And we could have picked Nestle to look at. We could have picked virtually any traditional company, and you can find arguments for and against inclusion. And I think that is something as a manager that you're very subconscious of, that analysis and review and due diligence to make sure that the exposure that we have reflects the position we want to be in for the mandates that we're managing. I think just touch upon wider asset classes. And we've been asked recently whether gold should be included within an ESG portfolio. As a sort of manager with commodities background, and where do you sit on that debate?
Another very good question. Gold has always been sort of a pivotal part of anyone's pension plan. Having a hard asset in there, very important. But I think it's coming under more scrutiny as to how we get that gold. And that's certainly coming into the more of the focus, and it's being looked at a lot more, and the ratings are being looked at. So we even spoke earlier that the price could even go up on that basis, because it becomes more valuable, the gold that's been extracted out of the ground. But the ESG road is definitely being set up, and the momentum has picked up, this year, and through the pandemic, we've seen a real uptick in the momentum, and it's very interesting to see how it's been accelerated. The focus on ESG, the focus on wanting to get that right.
I think that's a key point. It's funny how ESG investing and recessions and crises tend to go hand in hand. We saw it in 2007 to 2009. There was some momentum in ethical investing, SRI, impact investing, and ESG at that time. And then when the crisis hit, a lot of that momentum was just halted as governments and companies reverted to survival and to practical perspective, a difference, and that we will actually see change this time, and that in 12 months' time we're still going to be seeing the sort of positive noises coming out of the BP and coming out of governments.
I definitely think we're well on our way. I think this decade there's been a definite shift in gear, and the momentum, as I said, has picked up dramatically. There's a much bigger appetite for green investments, ESG, highly rated investments. And BP saw that earlier this year at the height of the crisis, when they had to raise money for their one energy project, their 400 megawatt energy project, and they were quite surprised to see the investors' appetite, at the height of the crisis when oil was collapsing. So I think we're well on our way, and investors would far rather invest in cleaner energy, and the returns seem like they're there. So.
And I think that's maybe an open question for the audience and for trustees in general. Are you seeing more tangible clients taking a strong interest in ESG, or do you think it's a sort of something for the next generation? Are we seeing it being embraced fully? And I think from Capital International's perspective, it's something we're not only adopting and we've had a strategy for 10 years, and it's something we're seeing renewed growth within, but we're also starting to implement that across our wider investment processes. And I think maybe that's the critical point, and it's got to be sort of driven by the industry, that if we embrace that change and investors embrace that change, it puts pressure on companies and governments to do likewise.
No, exactly. That's and that has happened. It's been a long 10-year road, and the ESG investors have done their job, and I think there's still some work to be done, but they've certainly got the momentum in the market, so it's good to see.
And I would just like to thank everyone for sticking with us on this webinar, and apologise again for the technical issues. We do have a question, I believe, from one of the attendees. So please, can you repeat the focus areas for the trustees? Yes, we will do. I'll send you those rather than running through each of them. But what we do have as well is a guide to ESG objectives that we're very happy to share with trustees. And much like completing a risk profile questionnaire or completing your overall investment objectives, I think it is a sit-down discussion process with clients to really assess their ESG objectives. And I think it is something that can be brought into trustees' processes and discussions in a very positive way. And I actually think it goes a long way to having a closer relationship with clients. As investment managers, we're very happy to help provide the tools for trustees to be able to do that, and willing to sort of engage in any ESG cases that you're looking at. But I think as a process, having ESG objectives almost as a questionnaire outlined is a very useful tool to have to cover. Some clients will still have zero interest in ESG, in which case at least you've covered it at an early point in the discussion. But often it's an area that can be an afterthought in the investment process, and you might find you're halfway to getting the investment mandate in place with a manager, when a client suddenly says, well, actually, I'd like it to be an ethical portfolio, or what about not including this, or what about focusing on a particular area, sustainable agriculture. For mentioned sustainable agriculture, we've seen a lot of interest from family offices, from institutional clients, and it is something that, again, within Capital International, we have a strategy in that area. So we will do a further webinar where we focus and drill down into sustainable agriculture as a subset of ESG. We'll send an invite out to everyone for that webinar, which will be towards the start of October. So, James, thank you so much for joining us for the webinar. Really good that you could meet some of the trustees that we're talking to, and thank you again, everyone, for joining us today. And we will follow up.